May 20th, 2026. 8,000 Meta employees open their laptops to a clinical, carefully worded memo. It's signed by Chief People Officer Janelle Gale. 10% of the global workforce, gone. 6,000 open roles, canceled. 7,000 engineers, reassigned to data tagging units. The official reason? Belt tightening. Meta needs to run leaner to offset the massive capital investments pouring into AI infrastructure. But 3 weeks earlier, on April 29th, Meta posted the most profitable first quarter in its history, $26.77 billion in net income, a 61% year-over-year surge. Revenue of $56.31 billion, up 33%, the best quarter the company has ever had. So how does a company having the financial time of its life fire 8,000 people? The answer isn't in the headlines. It's buried in the footnotes of an SEC filing. It's a story about an $8.03 billion paper tax benefit, a Treasury Department loophole called Notice 2026-7, and 6 executives lined up for a $921 million payday. Let me walk you through the math, because once you see the 3 gears turning, the layoffs aren't a mystery anymore. They're a line item. Start here. July 4th, 2025. President Trump signs the One Big Beautiful Bill Act into law, Public Law 119-21. It passed the Senate by a single vote, 51 to 50. Vice President J.D. Vance broke the tie. Buried in the bill, a provision letting companies immediately write off domestic R&D costs, permanently. 100% bonus depreciation, also made permanent. For Meta, which spends tens of billions on R&D, this should have been a windfall. It wasn't, not yet. Here's why. Meta had been sitting on enormous deferred tax assets, DTAs. Think of them as IOUs from the IRS, sitting on the balance sheet, waiting to offset future tax bills. The 2017 Trump tax law had forced companies to capitalize R&D and spread those deductions over 5 years. Meta paid extra cash taxes up front. In exchange, it banked billions of dollars in future deductions on its balance sheet. Under GAAP, the accounting rulebook every public company follows, when the law changed in July 2025, Meta was required to remeasure those assets immediately, and the math turned ugly. Because of something called the Corporate Alternative Minimum Tax, CAMT, a 15% floor on book income for any corporation averaging more than $1 billion in annual profit. It was created by the Inflation Reduction Act, signed by Biden on August 16, 2022. The new R&D write-offs collided head-on with the 15% minimum tax. Meta's accountants ran the projections and realized they couldn't fully use the old tax assets they'd been carrying for years. GAAP forced them to take a valuation allowance, accounting language for writing the DTAs down to whatever portion they could realistically use. October 29, 2025. Meta's Q3 earnings hit. Revenue is fine, $51.24 billion, but buried inside, a non-cash tax charge of $15.93 billion. Net profit plunged 83%, down to $2.71 billion. Reported EPS collapsed to $1.05. The stock dropped 9% in after hours. Wall Street panicked. Investors thought Meta had lost a fortune. It hadn't. It had only written down a tax position on paper. No cash had moved, but the headline number looked catastrophic. Forbes called it Meta's tax whiplash. The reported effective tax rate for 2025 ballooned toward 30%. For a company that had been paying single digits, it was a shock. Cut to April 15, 2026. Tax Day. Senator Elizabeth Warren takes the floor of the Senate Finance Committee. She accuses Meta and Amazon of paying a microscopic federal tax rate, while ordinary Americans get crushed by an understaffed IRS. Her numbers come from the Institute on Taxation and Economic Policy. In 2025, Meta paid an effective federal rate of just 3.5% on $79 billion of U.S. income. They avoided $13.7 billion in federal taxes, money the public never saw. Warren's line on the floor: the One Big Beautiful Bill reduced the corporate tax burden by $65 billion in a single year. And Meta, she said, took the windfall and handed their executives billion-dollar stock options. 3 days later, April 18, 2026, the Treasury Department quietly issues a piece of administrative guidance. It's called Notice 2026-7. Dense, technical, almost no press coverage, and it changes everything for Meta. The notice tweaks how previously capitalized R&D expenses get treated under the CAMT calculation. It lets companies write those expenses off when computing the minimum tax. Meta's tax team runs the new numbers. They realize they can reverse most of the $15.93 billion charge they took 6 months earlier. The valuation allowance, gone. April 29, 2026. Meta releases Q1 earnings. Revenue, $56.31 billion, up 33%. Ad impressions up 19%. Average ad price up 12%. And then, in the footnotes, an $8.03 billion income tax benefit, a negative tax expense, money the company never received from a customer, but money that flows directly into reported net income. Here's the split nobody talked about. Actual operating profit, $18.74 billion. Reported net income, $26.77 billion. The difference, $8.03 billion, is the paper tax benefit. 30% of Meta's headline profit didn't come from selling ads. It came from a Treasury Notice published 11 days earlier. And this is where executive compensation enters the story. Because that paper benefit pumped EPS, earnings per share, by exactly $3.13. Meta's own press release admits it in plain English. Excluding this tax benefit, our diluted earnings per share would have been $3.13 lower. But here's the catch. Investors aren't stupid. On the same call, CFO Susan Li raises 2026 Capex guidance to $125 billion, maybe $145 billion, for NVIDIA H100 and B200 chips, for data centers, for the power grids to keep them cool. For context, Meta spent $72.2 billion on Capex in all of 2025. The 2026 plan nearly doubles it. Wall Street saw straight through the tax trick. Stock fell 7 to 8% in extended trading. The paper benefit wasn't enough to offset the Capex shock. Meta needed more. It needed permanent, recurring cost cuts to protect EPS in the quarters ahead. 3 weeks later, May 20th, 2026, the layoff memo lands. 8,000 employees gone, 6,000 open roles canceled, 7,000 engineers redeployed into AI data training work. Janelle Gale's words, necessary to run the company more efficiently and offset the massive capital investments we are making to build the world's leading AI infrastructure. At a fully loaded cost of roughly $250,000 per worker, that's about $2 billion in annual payroll, erased from the operating expense line. Forever. The 6,000 canceled open requisitions strip out another $1.5 billion in projected future hiring costs. That combined $3.5 billion doesn't return to shareholders. It gets swallowed by the AI Capex budget. Payroll, traded for compute. The 7,000 reassigned engineers? They're tagging images, labeling outputs, doing menial work to train the models that will eventually replace them. And here's the kicker. On June 9th, the Financial Times reports Meta is preparing a multi-billion-dollar mandatory convertible preferred stock offering. If Meta is raising billions in fresh capital from Wall Street anyway, the payroll savings from those 8,000 layoffs were financially trivial, a rounding error against the $145 billion in Capex. The cuts weren't about cash. They were about margins, about EPS, about hitting a number. So which number? Roll back to March 15th, 2026, 2 months before the layoffs, 6 weeks before the Q1 tax windfall. 3 days earlier, on March 12, Meta's board had quietly approved the first executive stock option grant since the company went public in 2012, the grants landing on the 15th. 13 years without one. Suddenly, 6 grants in a single day. CFO Susan Li, CTO Andrew Bosworth, CPO Chris Cox, COO Javier Olivan, board member and former Goldman partner Dina Powell-McCormick, Chief Legal Officer Curtis Mahoney. Each one receives the exact same allotment, 653,865 stock options, expiring March 2031. The options vest as the stock climbs a ladder of strike prices, starting at $1,116.08, topping out at $3,727.12. To hit that top strike, Meta's market cap has to reach $9.5 trillion, a 533% jump from where it trades today. On April 10th, the executive compensation research firm Equilar ran the numbers on what happens if they hit it. Bosworth, $921.2 million. Cox, $921.2 million. Olivan, $921.2 million. CFO Susan Li with a slightly smaller RSU allotment, $786.9 million. The math, $625.6 million in options, plus $295.6 million in restricted stock units for the top 3. Lee gets 43,267 RSUs. The others get 79,324. Nearly $5 billion in combined potential payouts for 6 people, tied entirely to stock price. And here is the mechanical link. To push the stock toward $3,727, you need rising EPS. To raise EPS, you cut the cost base. That's what 8,000 layoffs accomplish. A permanent reduction in operating expenses, locked in quarter after quarter, lifting reported EPS for every quarter the options remain outstanding. June 16, 2026. A leaked recording from an internal town hall surfaces. CTO Andrew Bosworth, the same Bosworth standing to make $921 million, is blunt. Morale is probably one of the worst it's ever been in the 20-year history of this company. We did an atrocious job with this recent restructuring. This is the same executive who, in 2023, told disgruntled employees, "You should quit if you feel that way." 3 years and one option grant later, the tone has shifted. Zuckerberg himself admits, "We've made mistakes." This is the same CEO who took personal responsibility on stage for the 2022 layoffs and the 2023 year of efficiency. This time, no public apology, just an HR memo. And Zuckerberg himself isn't on the option grant, but he holds tens of billions in existing equity that benefits from exactly the same EPS math. In the UK, Meta employees are now organizing into a labor union, citing what they call cruel and short-sighted executive behaviors. Over 1,600 employees have signed internal petitions protesting Keystroke tracking software. They believe it's being used to harvest their workflow data, to train the same AI models designed to replace them. The employees are, in effect, building their own replacements while their badges are being deactivated. So put the 3 gears back together. 1. A Treasury Notice creates $8.03 billion in paper net income. 2. 8,000 layoffs strip at least $2 billion in recurring payroll, protecting future EPS quarter after quarter. 3. 6 executives sit on 653,865 options each, waiting for the stock to climb the ladder toward $3,727.12. The macro story you were told, Meta's tightening up for the AI race, was true on the surface, but it wasn't the engine. The engine was a compensation structure that turned human payroll into ammunition for a stock price target. The layoffs are the propellant. And this is the part that should worry you, because Meta isn't unique, it's a template. For 2 decades, Silicon Valley operated on a talent-first model. Engineers were the asset, the lavish perks, the stock grants, the campus food, all designed to attract human capital. That model is dead. The new model substitutes payroll for compute. Workers are an expense line to be liquidated. Chips are the asset to be accumulated. Meta proves something to every CFO on the planet. You can fire 10% of your workforce during your best quarter ever, and Wall Street will applaud the discipline. Expect every major tech company to run the same playbook, the same EPS math, the same paper tax windfalls, the same executive options pegged to impossible valuation targets. The career ladder that once let an individual engineer climb into the executive class is being dismantled, one restructuring at a time. The merit path is closing, the lottery path is opening, for 6 people at the top. What's left at the bottom is the desk that used to be yours, a keystroke log, a severance packet, an AI model trained on your last 3 years of work. And at the top, 6 people, watching a stock chart, waiting for it to hit